There's an ongoing debate that whole life insurance is a better investment than the stock market and your retirement account. The truth is, whole life insurance is a terrible investment. My name is Darius.
And I'm Carmen. That is right. Whole life insurance is a terrible investment. The stock market is an investment. Retirement accounts are investments, but whole life insurance is purely insurance. So when it comes to whole life insurance specifically, it's not always for everyone. In fact, 50% of Americans don't have life insurance because they either can't afford insurance or they don't understand it. So by the end of this video, we want to make sure that you understand the differences between term insurance and whole life insurance specifically so that you can make the best decision for you and your family. And we're going to share with you a little nugget towards the end as far as understanding why wealthy people let the banks pay for their premiums so they don't have to come out of pocket for their insurance costs.
Now, the first thing that we want to talk about is just the difference between term insurance and whole life insurance, because like Carmen said, 50% of Americans don't have life insurance because they don't understand it. So when it comes to term insurance, what exactly is term insurance? It's a type of life insurance policy that provides coverage for a certain period of time, like 30 years, 20 years, 15 years. It's only for a certain period of time. And if you die during that time that policy is enforced during that term, then your family will get the death benefit. Now, term insurance is the cheapest type of insurance, life insurance, to get because it's only for a certain period of time and it's only the death benefit. So, for example, if I'm want to get $1 million insurance policy, I can pay $50 a month and I can have that $1 million policy in force for the next 30 years. Now, another reason why it's important or why it's cheaper is because 96% of term policies don't pay out because the person that is insured doesn't die during that time frame. Again, that goes back to why it's so cheap. So if you don't have life insurance and you don't understand, the best type of insurance for you to get is term because it's very simple, it's very basic, and it covers you in the event something happens during that time frame.
Now, one thing that I want to share with term insurance is a lot of people like us, we were drawn to term insurance initially because of the cost. Like Darius said, $50 for $1 million in death benefit? Like, yes, sign me up. Can I get that, please? But what
we take 2.
or 3. But what we didn't take into consideration with term insurance, and again, we're telling you our story in particular, is we undervalued the term piece of things. What I mean by that is we were thinking, oh, great, we're good for 15 years. But what happens 15 years from now?
And 15 years came up quick.
Yeah, it came up real quick. Not only did the cost of insurance go up because we're 15 years older, but what could have happened in 15 years for us with our health, right? A lot of things could have happened in 15 years. Thank God it didn't, knock on wood. But the idea is you could be uninsurable 15 years from now, 20 years from now, 30 years from now. And again, if you're just looking at that cost, not realizing that we need to forecast the future, maybe this might not be the best option for you because you're going to have to continue to renew your insurance every single time that term comes up. The premium is also going to go up and your eligibility may or may be affected. So the idea of what we want you to think about, if term insurance is really where you are from an affordability standpoint, then we highly recommend that you get something called convertible term. And convertible term means that in the future, you can convert that term policy into a permanent policy or into a whole life insurance policy, which we'll talk about in just a minute, so that you can continue to allow that policy to live on. So something to think about as far as what your options are. If you can afford term insurance right now today, then look into a convertible term policy so that you can move it into a permanent product and you can move that death benefit into a different policy. Now, if you want to know more about that information, then definitely click on the link below. We would love to serve you at the Wealth Nation and hook you up with a convertible term policy.
Nice. Now, the thing to understand when it comes to the convertible term is the fact that you have to do it before that term is up.
Good point. Very good point.
Yeah, you have to do it before that term is up. Now, when it comes to a whole life insurance policy, it's a type of permanent life insurance which you're insured for as your entire life. It's as long as that policy is in force, your beneficiaries can benefit from that if something was to happen to you.
And that's what gives you that's what is the big difference between term and whole life, right? So term is only for a specific time. I hate to be redundant, but we want to make sure you're tracking with us. And whole life is a policy that is going to stand your entire life.
Right, because the contract itself is for 100 years. Or 121 years, whichever comes first, either you or the policy. Now, I personally have a whole life insurance policy, and I have about $630,000 of death benefit, and I had it for a couple years, and I pay $4,000 a year for it. So that's
one policy.
And that's one policy. We have a total of 6 in our family. So that's one thing to think of when it comes to the difference in expenses, because it's a different contract altogether. You have term, which is for a term, and then you have your permanent whole life, which is for your entire life. Now, what gets a little confusing when we talk about whole life is the cash value. And the cash value is a portion of your policy that accumulates over time, and it may be available to borrow against for long-term savings needs, such as retirements. Now, I didn't say investments. I didn't say you invest in whole life insurance for the cash value. I said that it allows you to borrow against it for long-term savings needs.
Now, let me interject here real quick. With whole life, it allows you to have something called living benefits, which is different from term, right? Term is just pure death benefit. There's nothing else that you can do with term insurance. But with whole life insurance, what it allows you to do is essentially go to a buffet, right? And you can say, along with my life insurance, I want one of these, I want one of those, and I want one of these. And one thing that we very much value with our policies is something called the cash value, like Darius was referencing to. The cash value is automatic. It comes in every whole life insurance policy, but how aggressive it grows is going to be dependent on how your agent designs the policy for you. But you can pick all sorts of things called riders or living benefits that attach themselves to your policies. We won't go into a lot of detail as far as that because we don't want to drag this video out. But the idea is you have more options available to you with permanent life insurance, which is another reason why it can be more costly, because it's not just insurance. It gives you other benefits that you can utilize while you're living.
Right. Now, one little point that I want to make is that the interest that you can earn in your whole life insurance policy is better than a savings account, but not as good as investing in the market or real estate, as an example. So that's something to take into consideration as to why insurance itself is not a good investment.
Yeah. And speaking to that, to dive a little bit deeper, is every time you pay your premium, there's going to be cash that accumulates in your policy. Again, talking about the cash value, and why people can maybe confuse a whole life insurance policy with a retirement account, for example, is because when you pay the retirement account, right, your money goes into the stock market and gets invested, and maybe there's some money available. You pay your premium, and maybe there's some, or maybe there is money that's available to you, but that doesn't mean that it's an investment. If anything, we want you to kind of compare the cash value that grows inside your policy to like a savings account, because that's not an investment at all. That's just money that's available to you to use at your discretion. That's why the two can maybe get confused, but they aren't the same, and they shouldn't be compared.
Right. Insurance and investments work separately, but in parallel with one another. And I'll go through like some examples, because like when it comes to term, people say that term is more affordable. And what they're saying is, for example, buy a convertible term, and the difference that you would pay in a whole life insurance policy, because you can't afford a whole life insurance policy at the time, you invest that difference into the stock market or to your retirement account needs. The key here is to start when you're young. Because time is on your side when you're young. So when you're young, okay, get you a term policy, and the money that you would have put in a whole life insurance policy, take that difference and put into the market and into some investments. That's the idea of it. Now, when it comes to whole life, because we have a cash value accumulation in it, it changes a little bit. It changes the scenario. Now, in both scenarios, you'll still have life insurance and you'll have your investments working separately. Whole life, as your income increases and your financial situations change, you can convert some of your term life to whole life, just so you can have that use that cash value to invest instead of using your own money. And the key here is what I said, instead of using your own money, because this allows you to have a guaranteed death benefit and your investments working in your favor. Because you're using OPM, you're able to mitigate your risk. So if you invest in the stock market at the wrong time with your funds and the market goes down, then you lost the insurance company's money and not your personal money in your savings account. So it helps you mitigate your risk a little bit. And as well as when you receive the rewards of a great investment, then that money goes back into your system and everything's fine. But the key here is to understand that you don't have to choose. You should choose both. Take both in the scenario. Have your $1 million worth of term insurance, convert a portion of that over into whole life, and use your cash value from your whole life to do your investing, so you can have the best of everything.
All right, so let's do an illustration. Let's put a line down the middle of us. You are a whole life insurance policy holder, and Darius already said he's paying $4,000 annually for his premium. I am a term insurance policy holder, and I'm paying $1,200 a year, or $100 a month.
So that's a difference of $2,800.
Yeah, exactly. So the idea is my term, let's call it, is for 15 years, and Darius is he's paying $4,000 for
121 years.
Yeah, for his entire life.
Which I'm going to go 122.
So if I am paying $1,200 a year, the difference that I'm saving, which we said was $2,000, let's call it $2,000, right? I should
$2,800.
I knew he wasn't going to let me leave the $800 out. If I am saving that $2,800 cost, then I should be putting $2,800 in the stock market of my money,
or real estate investing, or whatever your
investing. Yeah, your investing choice, right? So $2,800 plop should go into whatever my investing choice is. So I'm going to say real estate because that's what I like to do. So the idea is every single year I should be investing at least $2,800 because that's the difference of what I could have been paying for whole life insurance and putting that into investing. So the idea is I am using my own money to invest in real estate, right? So Darius, tell me what you're doing as a whole life insurance owner, what you should be doing.
What I should be doing. So as a whole life insurance policy owner, I have cash value that is accumulated in my policy since day one because that's the way my policy was designed.
You pay $4,000 and some cash is available.
So I take $2,800 from the cash value that's accumulated, and then I still invest that money into the stock market, or let's say real estate investment. Now, we both are in the market with $2,800. The difference is you have more death benefit, which lasts for a term, and I have less death benefit, but it's available for me for the rest of my life.
And the difference is every 15 years, I'm going to have to re-up. My cost of insurance is going to go up. I may be insurable, hopefully. And the idea is I'm continuing to use my own money to invest, which is fine. But the idea is when it comes to investing, we always want to use OPM. We never want to use our own money so that our cash can stay liquid.
Right. And what I'm going to do is I'm going to take the interest that I earn to pay for my policy premium so I don't have to pay for it. And I'm going to continue to invest money and not have to worry about it.
See the difference? So that's why it's important for you to understand what is the opportunity for term insurance policy holders versus whole life insurance policy holders. And we're not saying that either one is right or wrong, but we just want to give you that illustration so that you can see what your options are. The other thing that we didn't take into consideration is hopefully every single year your income should be going up, right? So that means that your insurance death benefits should also be considered, because if I'm making more money, that means I need more insurance. So regardless if I'm a term policy holder or a whole life insurance policy holder, I still need to be making sure that I'm covering my income should something happen to me. Now, what you can do, you can remix it a little bit. If I am a whole life insurance policy holder like Darius was, and he had $600,000 worth of death benefit.
630.
See, he's not going to let me leave the change on the side. I hear you, babe. So the idea is if I only have 630 for this example, $630,000 worth of death benefit, and his income goes up, then I need more insurance. So maybe at this point I can get another whole life insurance policy if it's affordable to me, or maybe I can get a convertible term policy. So now I have $600,000 plus maybe another $1 million worth of death benefit to cover my assets. And then when it makes sense for me, I can convert that convertible term into whole life insurance down the line.
Right. Now, this sounds well and good, but one of the differences is if I get some type of chronic or terminal illness, I still have my insurance.
Exactly.
I still have my insurance, and my insurance still continues to grow up as I pay my premium every year.
And the difference, right, for me,
that's not the case.
That's not the case.
That's not the case. Once your term policy is up, you can't get another insurance policy because you have a terminal illness, and insurance companies aren't going to insure you moving forward.
Exactly.
With that. Now, another thing is that wealthy people kind of do a combination of the both. You know, we say buy term and invest the difference. What wealthy people are able to do for people that have a significant net worth, instead of them going to buy, let's say, pay a premium for $1 million, what they'll do is they'll get the banks to finance that premium for them. And the money they would have put into the premium for a whole life insurance policy, they take that difference and invest it, so that they have those funds available. Now, what the banks use as collateral is the cash value, because after about 10, 15 years, the banks know they'll have their money back plus some, and they take that money and they walk away. They have their money, and the insured is happy because they have millions of dollars worth of death benefit that they didn't have to pay for. And on the side, what they did with the funds that they didn't have to pay is they invested it and made even more money. So the reason why we're saying this is important is because the key here is following through with what you say. If you're going to buy a term and invest the difference, do that.
You need to invest the difference.
You need to invest the difference. Even when you buy a whole life, use your cash value for your benefit and invest those funds so that you have more money available. Because that's exactly the blueprint that wealthy people and rich people have given us, is the fact that whole life insurance is a foundational asset. That's why the banks would fund it for wealthy people. The insurance company loves it because they have their premiums pretty much guaranteed because the banks have money. It's a win-win-win situation for everybody involved.
And the other thing too to note is what I was saying in the beginning of this video, is that 50% of Americans do not have life insurance. And that's why we wanted to make this video for you all today, so that you could make sure that you understand the differences of what's available to you when it comes to just pure insurance, term insurance versus whole life. None of these have to do with any investing, or you're not investing cash values elsewhere, just pure insurance, so that you can comprehend how to move forward, because it is not okay that only 50% of Americans have life insurance. All of us, unfortunately, are going to die at some point. And not to be morbid, this is just real. You need to make sure that all of your income is going to be covered should something happen to you or any of your family members.
Right. At the end of the day, insurance is a foundational asset that should be a part of everyone's financial plan, because death is guaranteed. And how you choose to invest in parallel is dictated by you and the people who you choose to have in your circle.
Now, Wealth Nation, if you are interested in getting insurance or you need clarity, please click on the link below. We would love to serve you at the Wealth Nation to make sure that you have all of your needs covered. And go ahead and check out our next video so you can understand how to borrow against your whole life insurance policy to invest.
Remember to own your own lifestyle,
or someone else will.